Well, WeWork on the verge of total collapse, and now it's threatening even tougher times for the commercial real estate market in New York City. WeWork occupies nearly 7 million square feet in Manhattan. That is more than double the amount of space inside the Empire State Building. Joining us now is Lee Overby, Barclays Managing Director and Head of CMBS Research. Lee, there's a lot of questions raised about this financial filing that came down from WeWork, where they said there was a going concern, often language that's sort of used with company being on the verge of bankruptcy. How much of this was the company trying to gain leverage in some of its lease obligations? How much of this was about the company's standing right now? Regardless of which it is, what is the impact or the potential impact on the New York real estate market, especially when they occupy so much real estate?
Well, again, thank you so much for having me on. I think one thing that's important to point out is that the New York real estate market is really quite huge. So in spite of the fact that this does account for roughly, twice the size of the Empire State Building, it's still just a little bit over 1% of all outstanding commercial real estate exposure or office exposure within Manhattan. So from that perspective, it doesn't seem like as big of a number. One of the problems facing Manhattan and many cities across the country, though, is that already we are at record high vacancies, or at least, as far back as we've been keeping records for about 30 years or so. So this just adds one more straw to the proverbial camel of higher vacancies across the country.
So, Lee, when you talk about the fact that this contraction phase that we've seen now for quite some time since the midst of the pandemic, it sounds like we're not towards the end of that yet. So I guess how much worse could this potentially get when it comes to office?
It's a very good question, and I wish I did have a solid answer. Many of us are trying to determine exactly that. This prior quarter has shown that the decline in occupancy has slackened off. So that doesn't mean we've hit a bottom, but it does mean that we are headed towards a bottom. So I would like to think that perhaps we will actually find another bottom by, call it, early next year. Then the other question comes about how long it will take us to dig out of this. So right now, this is a deeper contraction than what we had after the great financial crisis. And after that, we bounced along the bottom for about 2 years' time. So I really hope it doesn't take us to going on 3 years to finally recover from this. But if history is any precedent, it will be some time.
So, Lee, I want to get back to some of that context you provided on what this all means, or what the potential collapse of WeWork means in that vulnerable environment that you just highlighted, because you recently put out this report talking about the exposure for WeWork, saying, given the current weak fundamentals of the office market, especially in New York, we believe these locations might be a particular risk of closure because of over concentration. What are some of these areas? What are some of these locations we're talking about?
Well, WeWork itself, at its heyday in 2018, it was, as you said, the largest tenant in New York, and it tends to take very high quality space and large amounts of space. And so for an office building in Midtown Manhattan, say, that has exposure to the tenant, if WeWork does indeed file for bankruptcy or does renegotiate that lease, it could leave a very large hole that the landlord might then have trouble filling. For various reasons already, these landlords are strapped for cash. And so this could be yet one more issue that the landlord will have to face in order to be able to afford the mortgage that's on the building.
So, Lee, what does this do to valuations, and not just obviously when it comes to WeWork, but if we want to stick with New York City, what it could potentially, the pressure it could put on valuations here across the board?
So already we have seen declines in valuations. Last year in September or October, we put out research that proposed a 30% decline in office prices. At this point, I would be quite happy if it ended up being just a 30% decline. We have seen some indications that already prices have fallen closer to 40%, and in some instances even more than that. So this is one more thing that we're going to have to end up working through. So maybe this moves the needle from, say, prices being down 40% to prices being down 40 to 45%.
What are we seeing on the side of buildings and borrowers? How aggressive are they being in essentially offering incentives that will allow these tenants to stay in the building?
We have seen some, well, in the case of WeWork, it's not clear that there will be any incentive that will convince them to stay. The company itself needs, it seems, pretty substantial restructuring, and it needs to get out of a lot of these leases. But away from WeWork, we have seen an increase in the amount of concessions that landlords are willing to offer. And we've also finally seen some slight downturn in the rents that they offer out. So right now, for any lease that's roughly 10 years, the concession package is equivalent to about 10 months of free rent. So this is near, again, record highs. And we expect to see that to continue as the landlords who are able to do so provide nice amenity packages to attract more tenants.
And finally, Lee, we've had so many of these conversations about what happens to these buildings, these big office spaces, when the reality is a lot of these companies just aren't going to get employees back at those desks. We've heard some of the space being used for restaurants, mixed use cases. I mean, what are you seeing? How do you think some of these buildings transform?
Another very good question, and one that I don't really have a good answer for. There have been studies that indicate that upwards of maybe 10% could be converted to multifamily, but the multifamily conversions are quite hard. There have been other things that have been proposed, such as conversion to a combination of retail on the bottom, hotel in the middle, multifamily on top. But really, the truth is, when we start talking about any kind of conversion situation, it usually entails wiping out the equity entirely, and usually a big chunk of the debt as well, because the conversions only work if the basis is sufficiently low. So I don't want to cast a pall over all conversions, but in a way, for the CMBS market, the commercial real estate market, your biggest wish is that the building next to you is the one that gets converted while yours continues as an office property.
Sounds like a high risk of more pain that we could see here in commercial real estate in the coming months. Lee Overby, great to have you. Thanks so much for joining us here. Barclays Managing Director, Head of CMBS Research.